Hello, I'm Hunsley from Livewire Markets, and welcome to this feature interview. Our guest is Bob Desmond, Portfolio Manager and Head of Claremont Global. And today we're sitting down with him to get his views on the current state of the markets and some of the best stocks within the global equity universe for this stage of the market cycle and beyond. Bob, it's good to see you.
Hi, Hans.
Now, we've just seen the very tail end of the US reporting season, and I know you don't pay too much intense attention to the macro, but I thought it's just worth highlighting some fast stats with all of you out there in the audience. Put it this way, the earnings decline in Q1, first quarter of course, was the second in a row for the S&P 500. The 6.7% EPS decline, which was projected, ended up being a 2.1% EPS decline. More companies are now providing negative earnings guidance than positive earnings guidance. And yet, the forward 12-month PE ratio for the S&P 500 is 18. So with all that said, how much more challenging or easier has it been to pick stocks in this environment?
Hans, I think it's got a little bit easier. For us, generally stock picking gets easier when you get bifurcation in the market. So you get people busily buying one part of the market and selling others, and we quite like it when you get that dispersion. So obviously there's been quite a big rally in the large cap tech shares this year, which we've got good exposure to, but that means that they're selling something else. So there has been quite a lot of bifurcation. We've really noticed it not only across the portfolio, but across our watch list. So we quite like that when there's bifurcation across the market. Yeah.
Okay.
So it's been we're definitely seeing for us more opportunity open up.
So I mentioned there that the US stock market has a forward PE ratio of 18, which is historically at least still quite expensive. How long is that shopping list at the moment, just given the bifurcation?
The shopping list, we have a rule that anything coming into the portfolio needs to be at least at the same discount to value of what we currently on average, that we currently own. So that does set quite a high hurdle. I would say at the moment there's probably 2 we could add to the portfolio, but they're not really going to bring anything in terms of portfolio diversification, better value, better margins, better balance sheets. So it's not super long, but within the portfolio there are a couple of opportunities we can see, and we have been taking advantage of that in the last few weeks.
Okay. Do you have the dry powder? Do you need the dry powder to bounce if these markets take a turn for the worse?
It's actually interesting, Hans. We have to run with no more than 10% cash. Okay. So we can't go to max cash. At the moment we're around about 4%, so almost fully invested. We don't try and, the cash is just a residual. So normally what happens, it's normally a signal to us that markets are expensive when the cash just builds naturally. So towards the end of 2021, things were expensive. We would take profits in something, but then we couldn't find anything to recycle into. So we're pretty much fully invested. If I look at the fund, the PE on the fund is below its 10-year average. So bottom up, we feel pretty good with what we own. Our PE on the fund is probably 6 points lower than it was 18 months ago. So bottom up, we feel pretty good with what we own and pretty good about the valuation.
All right. That's good to hear. So talk me through that then. I mean, obviously you're talking about the quantifiable things that are changing in the fund. But what are some of the key characteristics, the values, the tangible stuff, if you like, of businesses that you think will thrive in this environment and beyond?
Well, the first, I'm not sure what kind of environment we're in actually, Hans. Depending on what the narratives from week to week. I mean, last week we were saying the Fed was done, or 2 weeks ago the Fed was done, and now suddenly we're saying after the jobs number the Fed has to keep going. So we don't try and pick things in the environment we're in. What we try and do is buy companies that no matter what happens, that they will be okay. And that's the same stuff you hear us always talk about: sustainable organic growth, sustainable competitive advantage. I think high margins are important, obviously, in this environment, especially with inflation lingering around, and then a strong balance sheet. And I think that's really important at the moment. It always is important, but it's probably more important at the moment, because if all the gurus out there are right and we do end up with a recession, obviously you want to have high margins, strong cash flow, strong balance sheets, and have some form of sustainable organic growth.
Yep, no, absolutely. I know as well you focus on return on capital, namely tangible and invested capital. How is the current environment impacting your ability to find companies who can beat the competition on those metrics?
I think we look for companies that that can perform what we say are all-weather businesses in any environment. So we don't change our approach from market to market, or if we're in a low inflation or high, we don't really change our approach from day to day, because we're always looking 5 years out. So, and we don't really know what's going to happen in 5 years. Even if I'd said to you in December 21, I mean, do you know anyone in December 21 who said interest rates were going up 500 basis points? And you know how much time was spent analysing all of that by all the gurus in the world, and they all got it wrong. I don't think even the central banks knew they're going to put up rates that much. So we just sort of reverse and say we don't know what's going to happen in the next 5 years. So whatever does happen, and we always want to prepare for the worst. That means strong balance sheets, strong cash flows, sustainable organic growth, competitive advantage, ideally no risk of disruption. And then if we have a good market, then our earnings growth will kind of carry us through.
Can I come back to the bifurcation point? And you were talking there about all-weather stocks. Can I just ask, how, do you think that there are more all-weather stocks coming into play now, or less of them because interest rates are going up? Basically, what I'm just asking is, how is your opportunity set changing?
What's happening is and I can give you sectors if you want. So we've seen the rally happen in the large cap tech shares, and everyone says the rally is very narrow actually. So a lot of stocks have been left behind or are falling. So if I look at our portfolio, Nike's lagged really badly. Consumer has lagged. There's another name we've added to the portfolio, which I can't disclose yet. We're still in the process of, which is in the consumer sector. Healthcare has been sold off quite heavily as well, because we've kind of come through the end of the pandemic. I hate that word, but the pandemic. So we are seeing opportunities in those parts of the market. So I do like it when there's generally that sort of bifurcation. We saw the same thing, remember the fintech 2 years ago, everyone was buying all the what I call the sexy tech, but then selling all the dinosaurs. That tends to throw up an opportunity. So we do like it when you get extreme parts of the market, because it means people are selling elsewhere.
And isn't it funny how the dinosaurs are now
slowly
coming back into vogue?
Visa's still around, amazing.
Yeah,
There's 100 million merchants in the world who want to take those cards.
It is still around, as is its main competitor, MasterCard. So talking about sectors though, I know you're sector agnostic, but is there a sector or a theme that you're finding more of your opportunities in right now?
We don't do it by themes, we just do it by valuation. And actually across the fund, we're only going to be in 6 sectors. At the moment, we're in what we call financial plumbing, things like Visa. We're going to be in business services, things like Aon, insurance brokerage. We're going to be in brands, things like Nike, LVMH. We like healthcare, but not pharmaceuticals, so healthcare services or precision instruments. And then obviously we like technology. And there's one other sleeve which we would own, is high quality industrials. So that's just where we find businesses that we think have sustainable competitive advantage. We can understand them. That's kind of all we'll ever own. So generally, where we go is not dictated by themes, it's dictated by valuation.
Okay, so those are, I guess, if you like, the 6 all-weather industries, I guess.
Yeah, those buckets we will be in. Yeah, we only follow about 150 companies worldwide.
Yeah, okay. So you mentioned then a few of those names there, but what is the largest holding in the fund right now?
The largest holding at the moment is Microsoft.
Okay.
It's obviously done well with the rally this year.
With the AI.
So it's just kind of grown into its size, yeah.
Yeah, no, absolutely.
We've had to keep sort of taking the top off it, because it keeps going through our maximum 10% breach, and then we have to take the top off it.
Yeah, okay. So is that where you're seeing some residual cash, or you're reinvesting that into other?
We just recycle it across the portfolio. So we have a kind of rule that if we're trading across the portfolio, we want to pick up at least 20% in valuation if we do that, because you don't want to be trading every day. So if we sell something, and we say, okay, let's say it's trading at 100 cents on the dollar, we want to be recycling that to something that's 80 cents on the dollar.
Yep. All right. Interesting. Just lastly, I understand you've just come back from a recent tour of US and Europe as well. What are some of the biggest lessons and takeaways you got from meeting CIOs and CEOs and people that like?
Yeah, it was very interesting. I hadn't been. Well, I was on holiday there last year, but I hadn't actually visited companies since before COVID. So that was a really interesting trip. First thing I noticed was America was very expensive. I was quite shocked, actually. I don't know if you've been there recently, but New York, I was stunned at how expensive it was. Just day-to-day things, eating out, getting a coffee, etc. That was quite a surprise to me. So all that money printing's obviously ended up somewhere.
In the coffee shops, obviously.
In the coffee shops. There seemed to be a real, we stayed at I won't mention the brand, but at the hotel we stayed at, And the service was absolutely appalling. I mean, there was just queues everywhere. They never answered the phones. It's so obvious they're short-staffed. The other thing that was interesting, there's been a lot of talk around the bank crisis in the States, and we spoke to quite a few of the bank software companies, and they were very much of the opinion that the US banking sector is in pretty good health. And those were isolated cases that we saw that has specific business models. And there are a lot of banks in America. There's over 4,000 financial institutions, and in the main, they're in very good financial health. So I think the headlines have probably been more negative than the reality on the ground. Obviously, people have been delaying decision making because of the debt ceiling, so that's behind us now. The consumer, I think, is in very, very good shape still. There's still an excess of savings built up, and you can, companies from Visa and MasterCard, American Express, Hilton Hotels, the CEO, was at a conference and said, every week they look at it and they can see absolutely no cracks. American Express can see the travel bookings out 3 or 4 months. So I think the consumer's still in very good shape. Obviously, there's been this shift from goods to services. So I think people were more optimistic than I expected. There's still all this sort of caution: when's the shoe going to drop with rising interest rates, inflation? So that was interesting to me. In Europe, by contrast, actually found things seemed to me very, very affordable, even compared to Australia. So that was interesting. But I think the main thing I noticed in Europe was just how strong the ESG drive is. I visited a company like Air Liquide, and they were I hadn't seen them in a couple of years, and I was just so interested in how the whole narrative had changed around carbon capture, carbon sequestration, what a big part of and it all comes from the EU directives. Even just Uber drivers, like every single Uber driver was driving an EV that I caught. In America, they're still driving 6-litre V8s in New York. I was like, this makes no sense. So that was quite an interesting. But I think Europe, everyone was cautiously optimistic, I'd say. Yep. Yeah.
Way to go around the world there, Bob. Thank you very much. It's good to see you again.
Thanks, Hans. Cheers.
And thank you for joining us. Remember, if you want to see more great financial insights and analysis like that, you know where to go, livewiremarkets.com. Thanks for joining us.